Hi, this is Jessica Darmoni. Thank you for joining us. I am here with Cboe Digital TV, and I have a special guest. I'm so honored to have former Commissioner Dawn Stump from the Commodity Futures Trading Commission. Thank you so much for joining, Dawn. We're happy to have you. If you want to talk a little bit quickly about what you did before you got to the CFTC, that would be great to give our audience some context.
Sure, absolutely. So I served in both the private and the public sector prior to coming to the CFTC. As you mentioned, we did meet when I was working for the New York Stock Exchange, and one of our affiliated business was New York Portfolio Clearing, and I worked with Walt Lucan, also a former CFTC commissioner there. And prior to that, I worked in the Senate and in the House with the House and Senate Agriculture Committee, primarily working on CFTC oversight related issues. And I left shortly after we passed the Dodd-Frank Act. So that was the last big piece of legislation I worked on, which was probably the last big piece of legislation that provided new authorities to the CFTC. So my background is not a legal background, which is a little unusual for CFTC commissioners. My background is economics, so my degrees are in economics. And I very much enjoyed my time at the CFTC. I would have never guessed that I would have had the opportunity to work on so many different, interesting, innovative products. My background is in energy and agriculture. And then when I worked for the New York Stock Exchange, I worked on a number of financial products. But the time I was at the CFTC was a very interesting time in working on new asset related products such as digital assets, event-based contracts. And so it was a really interesting time to be at the agency.
And it really prepared you for kind of what was coming down the line with the derivatives industry. Everyone knows what happened with FTX, and we've had all these conversations about offshore and onshore, and Cboe Digital is a U.S. regulated crypto exchange and clearinghouse, and we've always looked at FTX a little bit and kind of had our thoughts about the relationship between Alameda and FTX, but wondered about it. From your background, what did you think about FTX before November and then after November? There's like a before and after a little bit in our crypto industry right now.
Yeah, so I had the opportunity to meet with a variety of executives from a variety of different exchanges and market participants at the CFTC. And my impression while I was serving as a commissioner, I always tried not to focus too much on the personalities. There are a lot of interesting personalities in the derivatives space. I really tried to focus on the market offering and the way in which that market offering, even if it were new to the derivatives space, would fit within the context of the rules and the regulations and the protections that had been in place for the legacy products that we had at the CFTC and that we had regulated at the CFTC. I was struck, I would say initially, that at the urgency with which the FTX team seemed to wish to move forward with, either new products or changes to rule books, those sorts of things. And that's all been well established in the public domain. So I'm not disclosing anything that was private there, but there was a sense of urgency. At the time, I didn't think too much of it because I think most market innovators find the pace at which the regulatory agencies respond to their interest to design new products to be entirely too slow. So I didn't at the time think much of it. In hindsight, I think I realized that this haste could have been the result of the pace at which they were accustomed. Their business had grown extremely fast. Their businesses offshore, particularly, had grown really fast. And, the design of that business actually started in the United States and then was relocated to Hong Kong, FTX.com. And I think initially Alameda was also, a part of that. Was the initial business that Sam Bankman-Fried started, and then it grew at such a rapid pace that it made logical sense to perhaps develop an exchange-based offering for client work. And, that pace probably is how we ended up where we are now, that the pace of growth. It's very obvious now that there was not proper governance, there was not proper accountability, there wasn't compliance, I'm guessing, in many jurisdictions, at least where Alameda and FTX.com are concerned. My impression since the failure of FTX is that there was a disregard for fundamental customer protections, and those are very core tenets of what I think most regulators around the world consider to be the basic principles that market infrastructure providers should be developing alongside the development of their new products. And I think perhaps the development of product was moving at such a pace that there was a lack of attention to the development of of compliance, accountability, and governance structures. I will say that now, in hindsight, what's happened is horrifying to me as a former regulator, but I think that it's also an opportunity to highlight the apparent distinctions between what is still a solvent FTX entity that was regulated by the CFTC, and it, by all accounts, though I'm not there anymore, it seems to have subscribed to the fundamental customer protection regime that we hope all exchanges will comply with. But at the very least, I think it does provide an opportunity to compare and contrast that entity to the other entities that failed, because I think that it could serve to inform the market going forward. And the market, by the market I mean the customers who may have thought they wanted access to products that may not have been as well protected, their money might not have been as well protected as it would have been in a heavily regulated environment. And with that heavily regulated environment comes a little bit of clunkiness. And so now I think we're at a point where market participants have to make a determination in weighing the basics for protecting their assets against perhaps the expensive and the less expedited approach of a company that can grow without those protections.
I agree completely with what you've said. I think there's an onshore versus offshore debate right now. And I'm wondering, like, how can the US work globally to regulate this market? Do you have any thoughts on that?
I do. So when I was at the CFTC, I had the opportunity on a number of occasions to represent the CFTC on the board of IOSCO, which is a collection of a collection of securities regulators who try to forge some compromise on standards that can be applied globally. Obviously, standards are not prescriptive regulations, but I do think that there has been, and there should be, more attention paid to developing standards that can be transferable from one global jurisdiction to another jurisdiction, because the reality is that I find it very unfortunate that many in the crypto space found it necessary to leave the United States to offer products in the way that customers were demanding. What's unfortunate about that is that some jurisdictions opted to design a new regulatory structure specific to crypto. In the United States, thus far, we've simply applied legacy regulations to the new asset class. And the answer is probably somewhere in the middle. The answer probably is that our legacy regulations afford protections that need to be embedded into the crypto market structure. But we may need to have allowances, or specifically we may need to design some new regulations for the types of service providers and intermediaries that are involved in the crypto space, because they don't look exactly like traditional intermediaries, or oftentimes they don't. There are some unique qualities in the crypto market space. And I think there's some unique demands from customers, particularly retail customers, who now, unfortunately, have been faced with the very real loss of assets. The fact that United States market participants have not been permitted to participate in some of these offshore exchanges has led to, I think, even more angst in this industry, because the reality is that when there's a demand to participate in a market, for whatever reason it may be, maybe it's fear of missing out, maybe it's a true desire to invest in a alternative investment. The reality is U.S. market participants have found ways to access these foreign exchanges that are not registered with U.S. regulatory authorities. That's not to condemn regulatory counterparts outside of the United States, those who regulate. For example, Europe has a very strong regulation of crypto assets, and they've redesigned. Most recently, under new legislation, they're redesigning, what fits properly, I suppose, for digital assets. And I think the United States would be wise to take note of what could be adapted, what needs to be preserved in the basic tenets of what we know works. And I think the participation in standard setting bodies such as IOSCO provides that opportunity to really have honest conversations about what standards work, what needs to be distinguished from centralized markets versus decentralized markets. How do we make them both work in a way that serves the market's needs? Because the market is the market participants will ultimately demand, providing them with new opportunities. And if those new opportunities can't be realized, I fear that they'll seek them out beyond the regulatory structures in the global space. And that's not the outcome that any of us desire.
I agree. I think the best ideal situation would be to keep everyone on U.S. regulated entities, especially Cboe Digital. But I agree. I agree. I have one last question for you. I really appreciate your time. Thank you. I wanted to go back to something you said about the pace of which they wanted to get their initiatives approved. And I was wondering, not just us, I think, as not an entrepreneur, but just in general, you want something done yesterday. You're excited about something. You want to get it into motion. You know what I mean? Sometimes you're impatient. And I think that that's not necessarily a bad thing, but there's definitely a need for understanding and patience. How can we as an industry work together to not meet at the intersection of safety and security, but also with picking up the pace a little bit? I'm not saying that it shouldn't, but we should meet in some sort of middle. Do you have any feedback on how we can work together to do that?
Yeah, I do, and I think that it's incumbent upon regulators and the market participants who are innovating to invest the time and energy it will require to design a new market. And this is a new market. The market structure may not necessarily need to be completely redesigned, but this market has some unique functions. It has some unique elements that make it worth everyone's time to collaborate. And when I say collaborate, I mean the regulators and the regulated. So the CFTC sees, for example, this is my experience, the CFTC sees so many different registration proposals, new product proposals, new rule proposals from the regulated entities that want to change their rulebook from time to time. And it can be overwhelming. And I think that it is important for the industry to try and coalesce around what makes sense so that they can help the regulators in the new design, if there needs to be a new design. And perhaps that is just as simple as saying there are some elements of the market structure that exists today that need to be reconsidered or redeveloped in a way that the new market for digital assets can thrive. And for example, one that I hate to almost bring it up because it has FTX written all over it, but FTX is not the only entity that ever went to the CFTC and said, we really don't want to use an intermediary in our clearing. That is the traditional way that the CFTC expects clearing infrastructure to operate, and for good reason. Those intermediaries provide the guarantee fund monies to the clearinghouse, as well as the facilitation of customer margin. But the CFTC has responded by saying, okay, fine, but your customers have to, their positions have to be fully collateralized 100% of the time. And that is a little bit of a that is a departure from the way the futures markets have traditionally worked, where there's been leverage and margin guarantees. So these are just conversations that need to happen, not because one is preferred to the other, but because we want to make sure the playing field remains level. We want to make certain that the incumbents who have used a traditional model have the same opportunity to compete as those who may come into this space as new market infrastructure providers in a way that I think the commissioners ultimately at the CFTC or the SEC are ultimately the ones who have to vote. So you may convince the staff of any one division at the CFTC that you're right, or you may very well find that they think you're wrong. But the reality is that you should go in and meet with the commissioners as well, because the commissioners are having conversations. They will challenge you. They will challenge the staff at the CFTC, and that's their job. And ultimately, it's their name that's going to be signed onto that approval or disapproval in some cases. And they take that very seriously. And so I do think it would behoove the industry to come together. Regulators recognize that you're all competitors, but it is for the best of the entire marketplace that the market infrastructure help the regulator design solutions for new asset classes. And then everyone can compete on a level playing field and design new client offerings in a way that make for a competitive advantage. But the regulatory structure should not provide the competitive advantage.
That's a good point. I also think you brought up the importance of intermediaries in this model, but I also think it's important to acknowledge the separation of duties as well, which was kind of missing at FTX. But I think that the separation of duties and each person wearing a different hat, so to say, or like each entity wearing a different hat, really, like, there's no conflict of interest in terms of trading desks or, so you or custody. So there is that separation.
I'm sorry, Jessica. I'm so excited. Well, I'm not excited that we have to talk about this. I'm glad you brought that up, because that's exactly where focus needs to be placed most immediately. How does the conflict of interest, when you have a parent entity who wants to perform a variety of functions within the system that have traditionally been performed by unaffiliated entities, what sorts of conflicts of interest parameters need to be established? And that is something that I know we can design standards around, and the industry should have input into that. Also, I think that this issue of custody, which is so fundamental to the traditional futures model, has seemed to be a little less, well, it will be important going forward, but it seems to have had a little less vigor, if you will, in some of the offshore entities. And, those who provide custody, I think, have struggled with their obligations. And I think that it's incumbent upon regulators to help make it clear as to what is expected of those who provide custody. But I also think it's important to have a enterprise risk management across the entire enterprise. There needs to be governance that supports the entire enterprise and the risk portfolio that they carry, and what that means in the context of offering a service. And the service may very well be that your customers are not well protected if you have a conflict of interest. But enterprise risk management is something that also seemed to be lacking at FTX, and that's pretty fundamental to most regulated entities. And so I don't want to oversimplify, but I do think that that's an area of focus. Governance, accountability, audited financials, transparency. Those are just basic tenets of regulated market structure that seem to have been absent from the FTX.com and Alameda operations. And certainly we expect those as basic tenets of U.S. market regulatory oversight. But in some cases, when we are talking about, you brought up the conflicts of interest, I do think there's some unique elements of the way this market has developed that may warrant increased scrutiny on conflicts of interest for the derivatives markets and the spot markets and the brokerage services that all may be performed by one entity.
I do think that is one big difference between like the traditional markets and crypto markets, is that that in the crypto markets everyone is wearing like the same hat.
Yep.
Yeah.
And I think, and for in some instances, I think that's because there are efficiencies in that, and customers want efficiencies. And I think where we are today, unfortunately, as a result of the FTX situation, is that customers are going to need to weigh the efficiencies they want with the protections they require. And we are now to a point where we can have that conversation in a very thoughtful way. Unfortunately, it is brought on yet again by somewhat of a crisis situation. But sometimes it really is the crisis that pushes people to devote the time and energy to making the tough decisions and having the difficult conversations. And that's where we are today.
I agree. I agree with you. I think that we can only go up from here, and we're going to rebuild from here. I completely agree with you. Yeah, that's a great ending note. Dawn, thank you so much for joining. I'm honored to have you on. You're welcome back anytime. Thank you so much. If you want to add anything, but yeah, we really appreciate your time. Thank you so much. And
I appreciate this. I don't get to do this very often anymore. I'm a little bit out of practice, so I appreciate your allowing me to be here, and I always love seeing you. So
thank you. Thank you so much.